Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney. We're counting down to Asia's major market opens.
I'm Annabelle Droulers in Hong Kong, and the top stories this hour. Asia's chip and tech stocks set to take the spotlight after Nvidia delivers a bullish sales forecast, bolstering confidence in the AI frenzy.
Anglo American agrees to talks with larger rival BHP, opening the door to what could become the biggest mining deal in over a decade.
Plus, we speak live with RBNZ Governor Adrian Orr about the central bank's hawkish hold and why he's still worried about sticky inflation.
That's a big conversation coming up as we continue to watch really the balance of risks when it comes to these economies, deciding when that first easing move will come. We do have a bit more data just coming through right now across the Bloomberg when it comes to Australia PMI. These are the numbers. The May flash manufacturing PMI coming in unchanged at 49.6, so still in that contraction territory. The composite number coming in at 52.6. Also a little bit of weakness from the previous reading of 53. The preliminary services number maintaining a little bit of strength above 53, but still a little bit of softening from the previous reading there as well. So we have seen recently kind of the RBA just resuming that conversation about rate hikes potentially at its previous May policy meeting before deciding, of course, to stand pat. But on these balance of risks, we are seeing some signs that economic indicators are starting to soften here after just a string of tightening. Let's take a look at how all of this is feeding through as we look at the futures picture across Australia and how Sydney is setting up for the start of the cash trading session. We are seeing quite a bit of weakness expected there. We've got Sydney futures down by just about 1%, though. Even as, of course, we've seen sort of the big risk factor of what we saw across markets this week, the Nvidia forecast shattering estimates, the AI boom still very much intact, but some of these concerns are out. The Fed minutes showing that sort of higher for longer narrative remains very much on hold. We're seeing a bit of a struggle for sentiment today. New Zealand looking pretty flat at the moment. Chicago Nikkei futures will be watching, of course, those AI and chip-related sectors to outperform. China futures looking a little bit weaker as well, Belle.
Yeah, but Heidi, it really is that focus on Nvidia and the performance that we're seeing after hours as well, because you can see this climb here around 6% at this point. You mentioned some of those key takeaways from the numbers so far. Really strong sales, a bullish outlook. We've got a stock split coming through. That's all I want to say there, because we do actually have a lot of coverage coming up ahead with our team. But let's take a look at what happened in the intraday session or broader session here, because futures are just coming online this morning and you are just seeing them, again, modestly high but fairly range-bound so far. Intraday, as I said, it actually was a story of declines that came through. We had the Fed meeting minutes coming out telling us that officials really no rush at this point in time to cut rates. We did actually see the two-year yield just climbing somewhat, the dollar a little higher as well. But the action, very much what's happening in after hours today. And yes, away from Nvidia, another one quickly to mention is what's happening with Live Nation, because actually we're seeing that stock there dropping as much as 10%. But we do understand that the US Justice Department is seeking to break up Live Nation and Ticketmaster. That is a Bloomberg scoop, and we'll have more details on that just ahead. But as we said, really that emphasis and that attention, everything over the course of this week has come back to Nvidia. And actually, Bloomberg Intelligence says the company's results prove the continued strong demand momentum for its AI chips. Senior semiconductor analyst Kunjan Sabani joins us now for more. And Kunjan, we know the expectations going into these numbers were sky high, but yet again, the company seems to have been able to meet those or even exceed them.
Yeah, I mean, this has become sort of the new norm now. We did, again, expected exactly what happened. However, I want to point out the magnitude of the beat and raise this time around was a tad bit lower than what we have grown accustomed to see in the high single digits or double digits. But we think the capital return to shareholders by 10-to-1 stock split, the 150% increase in the dividend and the free cash flow increase that we have been seeing should offset if there were any concerns around the growth.
Kunjan, how much longer can this extend, right? Just every time we're sort of, more than impressed by the stock and by the company and by the outlook. Is this sustainable?
Well, from the visibility we have, it looks like it is sustainable. Again, it's very hard. It's a beginning. You don't see such story. At least I've not seen this such story in the sector for the past 20 years. So something very unique. We are going from visibility of a year out, and at this point, the demand signals continue to be strong. Look, their top 40% customer base, which is the top 4 cloud and hyperscalers, have increased their capex spending for calendar 2024 by 44%. And those make up about 40% of Nvidia's revenue. So if you just focus on those who are going to spend almost 50% more this year, that alone can drive this rally. We are also seeing significant demand outside of this cloud customer base coming from consumer internet companies, sovereign wealth entities, which the company positively guided to being high single billion dollars this year. So a lot more demand from other areas coming and supporting sort of this continuation of this growth. So for as much as we have visibility into 25 and 26 fiscal, we think this can continue.
Yeah, it's really that question of where you're at sort of in that demand cycle. And this is actually something that Jensen Huang has been speaking about in the earnings call, if we take a listen to what he said.
The next industrial revolution has begun. Companies and countries are partnering with Nvidia to shift the trillion-dollar installed base of traditional data centers to accelerated computing and build a new type of data center, AI factories, to produce a new commodity, artificial intelligence.
It's not just about, of course, being, the focus on the data centers. What else are we hearing about the other business divisions and also these new chips, for instance, that it's bringing onto the market?
Yeah, I mean, just like I said, the growth is now, you're seeing sort of starting in enterprises, right? Other sovereign and regional entities. And the next chip, which is the Blackwell architecture, which we expect to sustain this growth rally, is not really a chip. It's a system. It's a platform solution. Don't forget, there's a big piece of software offering that they have that has just started, but we expect almost 100% growth in that business as well, which will start showing up in significant billions of dollars of revenue in the next 2 to 3 years.
Kunjan, there was talk about sort of new pipeline offerings, right? Is there any indication that there's a risk of sort of self-cannibalization for its products if people are more interested in what's to come?
I wouldn't say it's self-cannibalization. I would say that there could be some timing shifts where if a customer had an option to wait a couple of quarters to get the better performing product, they might decide to do so. However, the supply for all products remain constrained. So they could very well easily ship that product to another customer who's willing to take that right now. So it could cause, like I said, an intermediate short-term, near-term timing shift, but I don't think it should cannibalize any of their revenues.
That was our Bloomberg Intelligence senior semiconductor analyst, Kunjan Sabani there. And let's get more on the broader market analysis and the key takeaways for investors as well after those Nvidia numbers. Bring in our guest, Deborah Cunningham. She's CIO for Global Liquidity Markets at Federated Hermes and joins us in the Hong Kong studio this morning. And Deborah, as we were saying, there was so many expectations from a lot of investors that we would see a further rally, perhaps, if Nvidia managed to impress the market. And also perhaps that it could broaden out to other sectors as well. What's your view on that?
I think by slightly exceeding expectations and getting to a point that maybe is lowering some of the expectations going forward, it allows for the market to continue on its pace. But I don't know that it actually causes a huge rally going forward. I think that certainly the outlook from an AI perspective and Nvidia and other tech companies allows for amazing assumptions of growth, given this is a sector that is going to be impacting the education sector, the defense sector. I'm in the asset management sector. We have various uses that we're using, business, social, all sorts. So I think there's plenty of room to go. I'm not sure it's today based on these earnings.
What do you see then testing then? If you're saying that the rally won't be sustained, what's going to be then what drives it weaker? Is it your expectations around the US economy? Do you see weakness there in the consumer segment, for instance?
I'm not saying that it won't be maintained. I don't think that it'll go too much further. I think it'll be sort of maintained at the levels where it is now. Expectations could be higher if the U.S. economy continues to perform quite well. When you look at the employment situation, there's no real thought process that will be slowing down at any point in the near term. Inflation, the Fed's notes just came out that basically confirmed higher for longer for a period of time, that where we are is going to be, the place we stay at, that it's restrictive enough. They don't need to go higher. They don't need to go lower because inflation still has some stickiness associated with it. So I think we're looking more for, at least in the initial time frame, maintenance rather than continued outperformance.
Maintenance, does that also include perhaps a bit of more of a rotation out of the rate sensitive sectors and maybe taking a better look at or a closer look at value?
Definitely value, we think, is on the upswing. It was beaten down very far for a long period of time, and we're now actually to the point where we think that turnaround is solid and will continue. So, yes, we do think that value and a broader base of stocks may be what sustains and, is providing the next leg forward.
You say cash remains king. I mean, how much would there be, and I guess, in a balanced portfolio at this point for cash?
Well, when we were in a zero rate environment for such a long period of time, 10 out of 12 years, people got very good at bucketing their cash. So there's operating cash, strategic cash, core cash, and only operating cash at that point remained in the cash sector. Very small, probably 5% sector of most people's allocations. Ultimately, though, at this point, I think we have a lot of operating and core cash in there because rates are at greater than 5%. And to go with that longer dated cash into other sectors at this point, you take a hit in what you're getting from, kind of a not guaranteed, but a pretty much solid 5+% at this point. So I do believe there will, be some rotation out, but I don't think it's down to that, sort of 5% level that it was in the zero rate environment. I think that was kind of a floor. So we're looking at something that's sort of being maintained somewhere in the 5 to 10% area.
Speaking of unusual rate environments, it's been a very busy year and a bit for Japan, right? What sort of expectations have you built around what the BOJ will do and how much how exciting this next leg of the rally might be, given that we have seen a bit of a pullback and maybe some redirection of flows either to domestic bond markets or to other markets, be it, India or China?
Well, we certainly think that there is positive momentum in Japan, and what we've seen from a negative 10 basis points to a positive 10 basis points from a official rate perspective is leading that. It's hard to see where it gets to a point. I mean, I think the economy has to continue to be diverse and growing, and with GDP negative in the first quarter, there's room to grow, obviously, at this point. So the expectations are, again, sort of tempered because of where we think, kind of the diversity and the growth is coming from in Japan, and more probably you get that diversity and that growth when you go more broadly into other Asian sectors at this point.
And what are those other Asian sectors that you're looking at in particular in Hong Kong now? You mentioned before that you've been in Singapore. What's standing out to you?
Well, it certainly seems like, a full employment picture seems to be everywhere. The consumer seems to be very strong in most regions. China definitely has slowed down, but seems to have reached kind of a bottom plateau and is starting to pick back up again. So I'm not sure there's outstanding growth in any particular area at this point, but we're also very long in a business cycle. So, just to be able to maintain and keep going, I think is proof of, a recession or something that is, negative from a growth perspective being on the horizon. It's not great, outstanding growth that we're looking for, but more broadly diversified across the region, maintained growth.
All right, Deborah, thanks so much for your time this morning. That was Deborah Cunningham there, CIO for Global Liquidity Markets at Federated Hermes. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Of course, that focus very much on Nvidia, as you can expect. It's available on Daybreak Go on the terminal. It's also available on mobile in the Bloomberg Anywhere app. We'll have more ahead on Daybreak Australia. This is Bloomberg.
India decides. As the votes come in, can Prime Minister Modi win a third term? And what direction will India take next? With a focus on the economy, social divisions, and climate change actions that will influence the global story. Bloomberg's Haslinda Amin is live in Delhi, bringing you the latest updates as election results from the world's largest democracy are revealed. Coverage starts June 3rd on Bloomberg Television. Context changes everything.
Time for morning calls ahead of the Asia trading day, and Goldman Sachs CEO David Solomon says he currently expects that the Fed will not cut rates this year. He still doesn't see compelling data that would support the move. But Solomon adds that the average American is already feeling the pinch from inflation. He says that could heighten the risk of a real and palpable economic slowdown. Meanwhile, some investors see a weak Chinese currency burnishing the appeal of Hong Kong-listed shares over those on the mainland. Lombard Odier and UBP expect Hong Kong stocks to draw in more capital as the local currency is pegged to the dollar, shields investors for higher for longer US rates. Lombard Odier adds that fears of a yuan devaluation could further motivate investors to favour 8 shares instead. And this year's Sohn Hong Kong Investment Conference is beginning Thursday. We're going to actually hear from Sigmoid Capital's Wendy Chen. She's joining us in the next hour for a preview. And we'll also have more in store for you on Friday with special guests that are joining us live in Daybreak Asia.
And Belle, it is the Bank of Korea decision day today, expected to keep the benchmark rate steady. It's releasing new policy decision in the next few hours. The central bank may also be revising its growth forecast higher. Let's bring our Korea economy editor, Sam Kim, who joins us now for more. So Sam, you know, like a lot of these regional central banks, they're having to kind of recalibrate what the trajectory looks like in this last part of the cycle, right? And potentially does that include pushing back, easing expectations, given that we've seen the rate of growth, you know, some of the other indicators come in hotter than expected?
Well, you're quite right about it. I think the Bank of Korea is one of many central banks that have to, like you said, recalibrate their outlook for the economy because the economy is just simply doing too well. Especially with South Korea, the exports are doing very well, better than expected, in fact. That's largely because there's a lot of semiconductor demand, and Korea happens to be the biggest maker of the memory chips, advanced memory chips that get supplied to companies like Nvidia. And that's really leading the gains in exports, and that's helping the economy expand much faster, which means that, hey, the Bank of Korea has no real reason or incentive to, go ahead with an early policy pivot. So we're expecting a rate hold today again, and we might be seeing that for some time to come too.
Yeah, exactly. That's what I was going to ask here, Sam. Is that sort of the expectation that we just stay standing pat for quite a period to come for the BOK?
Yeah, that's right. For today, it's very likely because the economists that we've surveyed, every one of the 21 economists we've talked to expect a rate hold today. Many of them are thinking that a rate cut is going to happen probably sometime in the fourth quarter. Governor Rhee said early this month that the BOK might even have to reconsider whether a rate cut is even needed this year. We're going to have to watch whether he retracts that comment today or even builds upon it. But for the time being, because the economy is doing so well, it expanded much faster than everybody forecast in the fourth quarter. We're thinking that, hey, a rate hold is going to stay for quite some time.
Sam, what are some of the other concerns for the broader economy that would be weighing on the mind of the BOK committee as they make these decisions?
I think one factor that could be taken into consideration going forward is the credit market. There's been a sort of a slump in the real estate sector with a lot of developers struggling with the debt that piled up during the pandemic era. How does that unfold in the coming month with so much debt? There is going to be a lot of restructuring. If that plays out in a way that hurts the economy, I think the BOK is going to be taking that into consideration as it sort of recalibrates its timing for the a rate cut, potentially. A private spending slowdown, that could be one concern for the BOK, but we're seeing resilience in consumer spending for now. So there are a few factors, including export slowdown possibly, but for now, things look pretty strong.
Our career economy editor Sam Kim. And staying with central banks, we'll be speaking with the RBNZ Governor Adrian Orr later this hour. He'll be joining us to talk about what's coming next for the RBNZ after that hawkish hold yesterday. This is Bloomberg. Another story that we're following very closely, shares of Live Nation Entertainment falling in late US trading. Bloomberg revealing a Justice Department move seeking the breakup of the business over antitrust violations. Sources telling us that the case is related to Ticketmaster's unrivaled control of concert ticket sales. A 2010 merger of Live Nation as well as Ticketmaster has really been the subject of several antitrust investigations ongoing. So, this is such an interesting case, right, in terms of this antitrust suit that we're finding is now upon them. And some of the details that we know, it's going to be filed in the Southern District of New York. The dispute will be seeking remedies, including the breaking up of Live Nation. And this is really according to Bloomberg sources who have asked not to be named, given that this is, highly sort of confidential information. We did see that big reaction of about 10% or so for Live Nation trading in the late part of the session. But this really kind of is just one of the latest antitrust measures being taken by the Biden administration, Bell, given that we have also seen cases against the likes of Alphabet, the likes of Amazon.com as well. So this is the biggest US concert promoter. So it'll be very, very interesting and trickling down in terms of the huge criticism that we saw over the Taylor Swift tickets in 2022 and the sort of massive demand that we saw and some of that and how it played out, Bell.
Yeah, well, they actually certainly bungled that, which of course sparked a lot of interest in it. The massive demand for Taylor Swift tickets that we saw last year. But again, as you said, it is interesting when you put it in the context of what we've really seen from the Biden administration over the past few years, which is making competition a really key component of its economic policy. And that's why we're seeing these cases, as you said, against companies like Alphabet's, Amazon as well. But this one here, the latest, and as you said, Live Nation, the biggest US concert promoter, it merged with the ticketing giant Ticketmaster back in 2010. There were a lot of different provisions around that deal. It seems like the companies, perhaps, according to the DOJ, violated some of those conditions of the deal, and that's really why that investigation is coming about just now. So we'll see, of course, as we said, what happens from the US DOJ, given right now it's a Bloomberg scoop.
Yep. And but we'll continue to watch that, of course. Lots of concert goers would be very interested in what's going on there as well. But take a look at how US futures are ticking along at the moment. We're seeing a little bit of optimism. S&P futures are about 0.25%. It was quite an interesting reaction, almost a non-reaction across the equity side when it comes to the big Nvidia numbers, right? We did have tech sort of up in late hours, so the AI bulls really just being emboldened by another set of, all-round stronger numbers and the momentum in that trade. This is Bloomberg.
You're watching Daybreak Australia, and the top geopolitical stories that we're tracking this morning. Israel is recalling its ambassadors to Ireland, Norway and Spain after the three countries backed recognition of a Palestinian state. They plan to formally recognise a Palestinian state comprising Gaza and the West Bank, joining around 140 other nations that already do so. The move underscores how Israel's war against Hamas in Gaza is focusing attention on the issue of Palestinian statehood. Taiwanese opposition lawmakers are set to make a final push on Friday to pass a bill aimed at reining in new President Lai Ching-te's administration. The move is likely to inflame tensions on the island after protesters gathered outside the legislature this week to voice their anger. They say the amendments could be used to undermine the new government. UK Prime Minister Rishi Sunak has called a snap general election for July 4th. It sets his Conservative Party up for a bruising 6-week battle, trying to stop Keir Starmer's Labor Party from taking power. Labor's led opinion polls by about 20 percentage points since Sunak took over from Liz Truss in late 2022.
Now is the moment for Britain to choose its future, to decide whether we want to build on the progress we have made or risk going back to square one with no plan and no certainty. Earlier today, I spoke with His Majesty the King to request the dissolution of Parliament. The King has granted this request, and we will have a general election on the 4th of July.
Let's take a look at how commodities are faring. Of course, this big rally that we've seen largely driven by copper prices, but also, of course, some of the other enthusiasm that we've seen across other classes like iron ore there as well. Take a look at copper. We are seeing a little bit of a pullback, which is quite interesting given just the big run-up and the short squeeze that we have seen. That retreat from profit-taking, a bit of a drop in demand as well. This is really the biggest intraday drop in just about 2 years. So it has been a pretty fast and furious pullback from those record highs that we saw just earlier on Monday. So clearly investors taking some profits off the table. There's also new signs of demand weakness emerging from China as well. But of course, copper is still up by over 20% this year with that big rush of investors worried about the tightening in that market. Also watching aluminium, we're seeing that also seeing a pullback after alumina surged aluminium, surged to that 23-month high with the force majeure being declared on a shipment from Rio Tinto. That's also seeing a little bit of a consolidation in that price there. We're also dealing with record gold prices here as well. The dollar firming and that sort of playing there as well. But the gold price still seeing a little bit of upside. Crude, though, holding pretty steady at $77 a barrel. We've been fairly sort of range bound for that, but those hawkish Fed minutes seeing a bit of a pullback in oil there. BHP is one to watch when trading begins in Australia in the next hour. In fact, in about 25 minutes' time, the world's biggest miner has won an extra week to convince Anglo American to agree to that $49 billion takeover plan. For more, let's bring our commodities reporter, Martin Ritchie. So, Martin, we were counting down and wondering if sort of they had enough time to get this done. What do we expect in this extra time that there is for reconsideration?
The saga continues. We thought yesterday it was a case of walking away or going ahead with the deal, but BHP, as you said, has another week. Look, the thorny question is around South Africa. It looks like Anglo is now happy with the valuation that BHP is proposing, but the South African assets of Anglo are proving the most difficult part of this. BHP's plan is quite complicated. It involves Anglo spinning off two of its companies, a platinum producer and an iron ore producer that are listed in South Africa, before BHP then goes and buys the whole company. Now, Anglo's concerned that this puts too much risk on the shareholders of those two companies because South Africa's government might impose conditions on them, and that would be unfair to them. So it looks like this extra time has been granted by Anglo to sort of let BHP perhaps come up with some kind of other structure, some kind of other plan. So it is a little complicated, and it's interesting also that the deadline day, May 29th, is also now the date of a South African election. It's becoming a kind of political issue in South Africa as well.
Yeah, well, that's what I wanted to ask about, Martin, because the approvals required for any deal here are likely to include those from South Africa as well. So is this, as we're seeing in the US, for instance, the Nippon Steel proposed takeover of US Steel, do you think it's likely to really factor into election politics?
I think the South African government has declined to make any comments at all. There have been some figures in South African politics more generally who have said they're personally opposed to the deal. I think BHP has said before they would prefer to have waited until after the election to do this. It is a complicated time to be engineering a bid for companies that has a very long history, more than a century in South Africa, but their hand was forced. So it's really all eyes on the South African businesses and what BHP does with the structure of this deal to ameliorate those concerns. That's what we're looking for now over the next week.
Right, and Martin, how much would they potentially realistically need to sweeten this, right? Because isn't there the argument that, well, they could also just wait, and over the next few years you would imagine that there's going to be greater competition and maybe a higher valuation after the restructuring has happened?
We've already had 3 bids. The last one, as you said, 49 billion, all of them rejected by Anglo. I think the signals that BHP is sending out so far is that this is final, that valuation is final. Anglo, we think, is also, I think, more happy with the valuation, but it's the structure that's important. But to the point about waiting until later, until Anglo itself is restructured, it has its own plan. Look, if BHP doesn't make the bid now, I mean, it might be that Anglo's valuation years from now is much higher, and they've missed the opportunity to do it this time round. I think that's probably the logic that they're going for there.
That was our commodities reporter, Martin Ritchie there. And a quick check on markets here because we're just under 20 minutes or over 20 minutes away from the opens for Sydney, Seoul and Tokyo. And the outlook today actually for equities is fairly mixed. There was a few different themes that we tracked overnight. Firstly, of course, you've got the Nvidia numbers after the bell here. That stock is rising around 6%. Yet again, the company, even though the bar is so high, they managed to jump over it. So really exceptional numbers there coming through and a really great outlook. At the same time, you also had the Fed meeting minutes, and they were discussing that need for the Fed to stay higher for longer. And that's really what we've been hearing from Fed speakers over the course of this week as well, but factored in as well into those Fed meeting minutes. So a couple of different themes we're tracking intraday in the session, continuing, of course, to monitor what's happening with Chinese equities in particular, because we've actually got them poised to deliver their best quarterly returns in more than 5 years. Currency, perhaps not quite the same story. There's some questions around capital flight, but part of that optimism around Chinese equities very much coming down to what we're hearing around the property sector. And now we're actually understanding that China's mega banks are already urging their branch managers to lend to state-owned companies buying up unsold homes. It indicates Beijing's sense of urgency to implement a real estate rescue package that was unveiled last week. Stephen Engel is our Chief North Asia correspondent. And Steve, what do we know at this point in time about this?
It is underscoring the urgency, absolutely. I mean, one of the biggest complaints about the government's efforts to put a floor on this property crisis has been it's been a piecemeal approach, for one, and it hasn't necessarily borne the fruit of the policy yet. And also, the implementation has been criticized. So why have we not seen a floor being put on it yet? Because confidence keeps dropping, contracted sales keep dropping, and defaults keep on rising. So this is interesting in that we're hearing from sources that already, after the PBOC announced last week that it would have this nationwide program to provide about 300 billion yuan, $41.5 billion US in cheap funding for SOEs then to go in and buy up the excess inventory that is out there. There's 3.6 billion square feet of unsold inventory of homes in China as of the end of 2023, the highest since 2016. So there's an urgency here. And this story that was a Bloomberg scoop late yesterday, essentially saying China's mega banks are urging those branch managers to act quickly, essentially, to get loans out to SOEs so they can buy up those unsold homes. Now, we don't know if this is going to lead to a massive surge in new lending because, again, they're also being urged to do the proper due diligence and, again, ensure that the funds that are lent out are not used elsewhere. They're going to be used for the intended purpose of buying up unsold units in pennies on the dollar, and then perhaps to turn into affordable housing, where other areas like the stock market could get better returns for SOEs. I'm not implying that SOEs would do something so nefarious, but it has happened in the past.
And Steve, in fact, there was another government program back in 2022 that offered developers loans guaranteed by the state. How did that sort of play out?
Yeah, so there was a program back in 2022 where authorities would basically lend developers with loan guarantees by this state-backed China bond insurance company, okay? So that was intended to give a support signal to developers in the market that they would support developers. But essentially what has happened over the time is it hasn't provided the liquidity necessary to prevent this wave of defaults. Agile is one of the latest ones. Now, Agile, it missed a payment on a publicly issued dollar bond for the first time last week. And Agile is one of more than a dozen developers that issued yuan notes guaranteed through the China bond insurance company. Now, so far, according to Bloomberg scoop that came out this morning at 7 a.m. Hong Kong time, at least 13 private developers, including Agile, had issued a total of 36 bonds via the program, with only $5 billion raised. That's just a drop in the bucket compared to the size, obviously, of the liabilities. And without a visible improvement in contracted sales in China, and of course, sales dropped again in April, without a sizable increase, most likely the defaults will continue by these private developers that just don't have the proper liquidity. So that program in 2022, which was supposed to indicate to the investors and to the market that the state would come to the rescue, hasn't necessarily panned out. This program that was announced by the PBOC last week is a different take on that, essentially to buy up excess inventories that I mentioned to Annabelle just a minute ago. And that, again, is just showing, again, that the policy in 2022 didn't work. Other piecemeal policies have not necessarily worked to restore confidence and improve the sales at these developers, which is really the only solution to prevent a further wave of defaults at this point.
Chief North Asia correspondent Stephen Angle there. We have more ahead on Daybreak Australia. This is Bloomberg. Take a look how Kiwi assets are trading so far this morning. The day after the RBNZ, which sort of the main takeaway was they see the cash rate cut starting later in 2025, kind of joining the overall hymn that we're hearing from a lot of these central banks of staying higher for longer and potentially pushing back these expectations of easing. This is a picture when we see a little bit of negativity there when it comes to trading across equities, down by about 0.1%. Pretty mixed picture here in Asia overall. Still sort of digesting the big Nvidia numbers, but also, again, from the Fed, that chorus of higher for longer as well from the Fed minutes there. The Kiwi dollar is maintaining some of the gains, 61.03. We do see the big jump in the Kiwi, leading that G10 space at one point after that decision, as well as the rise in yields as well. Well, the RBNZ governor says a broad decline in CPI inflation is not happening across all sectors of the economy. The RBNZ, as I said yesterday, signalling that policy will stay tight for longer after keeping rates unchanged for a seventh straight meeting. Joining us now from Wellington is the RBNZ governor, Adrian Orr. Governor Orr, it's always a pleasure to have you with us. I know you've been doing a lot of talking over the past 24 hours or so, and I'm going to ask you for a bit more insight into that decision. And again, much like the last time we spoke, the possibility of further tightening was again flagged, particularly when it comes to, some of these elements that you've said domestically have been perhaps more resistant to monetary policy. I guess the question would be, would another rate hike be meaningful when it comes to getting those aspects of inflation lower?
Another rate hike would only be meaningful if we thought inflation expectations were getting away on us again, starting to rise because of the persistence of actual inflation. We know that forward-looking inflation is heavily influenced by the current level of inflation. So that's our main concern. Persistence raises the risks that expectations don't do the job that's needed. We know and we are confident that we will get inflation down to the 1% to 3% band. We'd just like to make sure we get there soon without risking that another blowout in expectations.
You talked about the risk appetite as a committee and that the asymmetry is the ability to withstand the risk of higher inflation, right? Do you see that increased risk with some of these elements that are leading through to more difficult to shake inflation expectations?
Yeah, we're actually quite pleased. We spent a lot of time in the document we produced yesterday really getting down to the nuts and bolts or the rats and mice of what is left in that consumer price index, the bits that are persistent. We've seen a lot of success in getting the cost of housing construction down, a lot of other services prices down, goods prices, the easier to move. The bits to the left are insurance. They've all got their own idiosyncratic story. Insurance premiums, because of what's been happening globally around the extreme climate. We've got central and local government rates rises. They're always lagged. And there's some indexation left in the economy, which is keying off historical inflation. So, we're not surprised that getting from 4 to 3 to 2 is much harder than getting from 7.5 to 4. We are showing patience, but, we have to remain highly aware to any further upward price spikes and what that may mean for price-setting behaviour. We've been trying to emphasise... Sorry.
No, continue.
We've just been trying to emphasise that if price setters pull their heads in and accept that we're going to be in a low inflation environment, wage expectations and actual wages have come down considerably. So, we're just working through this last part of the puzzle. No difference to effectively what you're seeing globally. Tradable goods prices fell very quickly, and then this homegrown domestic stuff is always more sticky.
And I get that sort of non-tradables element is going to be crucial here as well. But you said that you have limited tolerance for inflationary surprises to the upside. Is that patience kind of almost running out? Do you look at that second quarter CPI print as the one that maybe makes or breaks that decision to go again or not?
No, we're not hinged off any one statistic. And no, patience hasn't run out. What we are showing is that we've got a lot of patience. Our projection is to keep the official cash rate at 5.5% until early next year. That we believe that will have inflation back down within the band, and at that point we can start thinking about normalising interest rates. That's all in our projection. The sticky prices that I've talked about, and particularly over the next couple of quarters, have been well signalled, and they are in our inflation projections. So it'd have to be something over and above that again to really, to surprise us. And we think the risks are balanced over the period ahead that matters for us this time next year. Without doubt, the economy is performing below its potential. An output gap is opening up. Disinflation is occurring. So, we feel pretty comfortable. But when you're starting from a higher inflation position, when you've got low productivity, the central bank has to remain alert.
Do you think, though, that given you are seeing those cooling trends coming in and you're really getting that weaker or softer economic data now, even though you have that component where non-tradable inflation data is still elevated, do you think that there's that need to get inflation back to that target band first before cutting, given there is that lag transmission effect as well?
No, that's you're exactly correct, and in fact our projections have us easing interest rates before inflation is back at that midpoint, because you are right. We have economic growth picking up here in New Zealand in our projections from this quarter onward, but the level of economic activity is still below the potential. So, we can start to ease before CPI inflation exactly hits the midpoint of that target, and that's what our projection has. We're at 2.9. I think our projections have us around 2.9% at the fourth quarter this year. That's a toss of the coin whether it's in or out of the 1 to 3 band, and it's not soon after that we signal lower interest rates beyond that. So what did we do to surprise the market? That it's not happening next week, and we've been saying that for some time.
You definitely do seem to have caught a few investors on the hop over the past few months. But Governor, you said that you expect growth to pick up. Where do you think that growth is coming from, and why do you think the New Zealand economy is able to cope with such a sustained period of elevated rates?
The growth is coming through from government spending, government investment. We are looking at private investment starting to come back. Building consents, etc., have levelled out. And importantly, we've had a 2% per annum growth in our working age population. So migration has been considerable. The really tough stuff is that aggregate demand has been rising, per capita spend has been falling. And the difference is the population's been growing. And so that has been putting the upward pressure on rents, on demand for dwellings, and that's kicking construction activity back in. The pipeline of infrastructure investment that's in front of New Zealand is long. And of course, the world is open up again. So our tourism is finding its feet. And likewise, with global growth expected to pick up, our trade is also growing. So there's lots and lots of economic growth, but there is that rebalancing from consumption to production.
Governor,
when it comes to some of the elements that you just talked about, dwellings, the supply side of dwellings, rental costs rising, if there is a sharper than expected decline in immigration, would that meaningfully change your outlook when it comes to growth? And does that more impact, when it comes to the labour market side or when it comes to the inflationary demand side, do you think?
Yeah, so, the real challenge is you can't just change one thing and leave everything else unchanged. The type of scenario there of if migration slowed much quicker, then aggregate demand slows quicker, and then we wouldn't be as exorcised about the level of interest rates. When the facts change, your opinion has to change on the way through. But likewise, we continue to have a dwelling shortage in New Zealand. It's not unique. It's in these countries that have experienced rapidly high immigration, and we need to keep building dwellings, public, state housing, public dwellings, private housing, so on and so forth. Housing construction costs have come right off. We've been successful at achieving that, but rental costs are high because there's still more demand than there is supply for people who don't own their own home but want to rent.
Governor, or very quickly before we let you go, you talked about fiscal spending as being one of the upside pressures. Ahead of the budget, do you expect that tension to continue to play out? Because we've seen across other economies where the fiscal side has, inadvertently or not, really undermined the effect of monetary policy.
Yeah, so, it's a global and forever challenge, the synchronised monetary and fiscal policy is extremely difficult. We've been fortunate here in New Zealand over the last couple of years. Government spending as a proportion of potential output has been declining, and that means it has been disinflationary. It has been helping the Reserve Bank. It has been disinflating on the way through. That is still the expectation from the official projections to date. Of course, we'll wait to see what the budget has. But, in the absence of that fiscal discipline, then yes, monetary policy would have more work to do. And so, we're going to have to see what, if any, additional government spending restraint will be, and the impact of tax changes.
Governor,
on
really great
spending.
to have you with us. Governor Adrian Orr there.